As you would imagine, it's a big story. Your first reaction, sir. We were up at 1.4% on Brent.
Yeah, absolutely. And of course, we're going to get that knee-jerk reaction similar to what we saw back in September when, guess who? Iran attacked the Saudi Aramco facility. And you did have that major spike in oil prices on that Sunday night leading into the trading week back in September, but prices quickly pulled back because there was no military response from either Saudi Arabia or the United States. This time it's different. Of course, we had the recent siege on the U.S. Embassy, backed by the Iranians, kind of, harkening back to the 1979 seizure of the embassy in Tehran. And of course, Donald Trump is not Jimmy Carter, and we had a very sharp response by the United States. So the game has changed now. The political military calculus has now changed, and we have now opened up a potential new front for oil prices. We're getting off to a very rocky, volatile start to the year. And as we expected to have been telling clients for the past year, this was to be expected. And I think the individual that you just had on the program put it very well, that the market is not positioned for this event. That is to say, when we look at the money flow in the option markets, a significant amount of upside protection was sold between around $62 and $65.25 in the NYMEX WTI market. So if we begin to broach that $65, $66 range, you're going to have a lot of option riders that are going to go into a panic, which could really propel a short-term spike in price. That's the risk on the pricing side. Of course, this is all going to be reflective of how Iran responds, and does this lead to a new plateau in the growing chasm between the Shia side of OPEC, Iran, and the Sunni side of OPEC, Saudi Arabia / the United States.
So, Stephen, just your gut feel then, how do I play this if I'm a trader right now? Do I look at the spot market? Do I look at the futures market? Or as you perhaps alluded to there, do I even have to look at the options market? And what would you do?
Well, the option market... Yeah, the option market, option riders, the guys who are selling options are typically considered on Wall Street the smartest guys, gals in the room, and they have sold a significant amount of upside production, as I said, in that, upwards of $65 to $66 a barrel. So, this is not NYMEX WTI. So that's the price area you want to respect. That's where all the quantitative models suggest elasticity could take you that high. If we begin to break that level, well, the rubber band has snapped, and then we can go significantly higher from that point. So that is the area. That is your jumping off point right now. If we cannot hold resistance in that $65, $66 range at this point, and right now I'm looking at prices, we're right around $63. So we're right at the beginning of that resistance area, but that is what I'm really going to be focusing on for clients over the next several weeks.
Stephen, how quickly can the sentiment in the oil market rebound given expectations of recovery in the global economy outside of the U.S.? Is that enough to provide some kind of buffer?
Yeah, I don't believe so. What we're looking at here is, here in the United States, for all of my analysis tells me that the U.S. industrial side of the economy, the factory economy, which is 1/8 of the U.S. economy, we're already in recession right now. So you're not going to get any sort of lift from the real consumers of energy. And of course, this is correlated to the ongoing trade rift between the United States and China. Now, to that point, China does not have any sort of incentive to settle a trade dispute with Washington until they know who is going to be the president of the United States in January of 2021. So there's not going to be any sort of meaningful resolution in the trade rift throughout this year. So that means there's going to be a significant industrial demand drag on energy prices at this point. So if we get a nice resolution that we don't see any sort of further provocation geopolitically in the Middle East, and then when we add on the pullback, the drag on industrial demand, then this spike that we're currently seeing in oil prices prices is going to be short-lived. So the risk really now here, and if you're Iran, this is a risk because the only way you make money if you're Iran is you sell oil. But if oil prices spike at the same time industrial demand in the United States, in Europe, in China is lagging, you're just going to exacerbate that demand destruction. And ultimately, you're going to be a loser on this proposition.
All coming at a time, Stephen, when OPEC is saying that its output is falling. That's the latest we're getting. I mean, how big a shortfall could that potentially be?
Well, right now the shortfall, by I think all conservative estimates, is that if OPEC lives up to its rhetoric, that is to say, if it expands its production quota from 1.2 upwards to 1.7 million barrels a day, which is what they stated, then ultimately what you'll see is their production that they're going to be pulling off of the market will dovetail with the amount of demand growth we're expected to see. So by the first quarter, let's take the geopolitics out of this, we should see a rebalancing of supply-demand in the market going to the first quarter, which sets a very good stage for oil prices going into the second quarter and the peak demand season of the summer in the northern hemisphere. So that is the game plan. But all eyes now are going to be on, well, will OPEC actually live up to its commitments? Because keep in mind, the United States, its oil production is going to grow probably upwards of 1 million barrels a day through 2020. So whatever oil OPEC pulls off, the United States, to a great deal, is going to mitigate that by the oil they're going to be putting onto the market. So if you're a gambler, it's almost of a push right now. So, and I think this is why, when we go back to gambling and we talk about the option riders, why they were valuing a ceiling to this market in NYMEX WTI in that $65 to $66 range.